Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. Danny Ratliff joining me this morning. We're going to be talking a little bit about the presidential election cycle, investing for that, kind of what to look for as we move into the November-ish timeframe for the election. So we'll get into that this morning. Some interesting stories out this morning. So first of all, this week we're going to get the Q2 GDP report. Now this is the first estimate out of 3. But this is where we'll see the first glimpse at what Q2 is. Now, the Atlanta Fed GDP, which does the real-time GDP tracker, their estimate has been rising as of late. They're up to 2.7% for the second quarter GDP. So fairly robust number, suggesting that the economy is doing just fine. Obviously, no concern at this point about a recession, at least in the near term. Even though we still have a lot of these indicators out there that suggest there's something else going on. Temp hires, as a good example of this, is declining, right? So, this is what you would expect. If the economy is coming under pressure, the first thing that companies are going to cut is temporary hires because they want to keep their full-time employees. Full-time employees that are good, they're hard to get, they're hard to keep. So, I hire some temporary work to fill in gaps. Those are first to go. Then full-time employees come next. But so that decline in temp hiring certainly suggests there's some economic stress in the markets. Also, delinquency rates. The number of people that are delinquent on both credit cards and auto loans, more than 90 days. So, right? So this is more than you haven't made a payment in 90 days or more. That number's been rising sharply. And as we talked a little bit about yesterday, I posted a chart on X yesterday about the delinquency rates and what was the number one excuse for credit card and auto loan delinquencies, right? So you get a call from the creditor. He says, why aren't you making payments? I'm unemployed. So unemployment has been, as the reason for being delinquent, has been sharply rising as well. So there's certainly some issues, right, that we see with the economy. But again, you take a look at these economic data points, absolutely no worry about a recession right now. Everything is fine. Right? It's all good. 2.7% GDP growth, economic surprises starting to tick up here a little bit, right? That's not surprising. When you go through a long period where economic data continues to underperform estimates, well, what happens is the analysts or the economists start cutting their estimates, right? So then you're going to get a period where the data comes in better than what was expected. So economic surprises actually turned up here a bit over the last couple of weeks. We've had some better than expected economic data coming in better than expected. That's the key term on that. So anyway, that's kind of what's going on right now. We'll see what that GDP number looks like. I think it's going to be closer to 2% versus 2.7, but we'll see who's right when it comes out this week. Interesting, this morning there was a report out, one of the largest test of universal basic income has concluded. And they ran a 3-year period where they sent people $1,000 a month. And the expectation is that, if you have an extra $1,000 a month, you're going to spend more time improving yourself, getting in shape, becoming more healthy, educating yourself, improving yourself in some form. What they found out was after 3 years of sending people $1,000 a month, leisure time went way up. The amount of income that they generated ex the transfer fell by 23%. In other words, they said, hey, I got $1,000 a month. I'm not going to work as hard, right? They didn't improve themselves. They didn't improve their quality of life. They didn't do anything that was expected. We were all told these great stories of modern monetary theory that, well, if we just sent people money from the government, it would make everybody so much better. It actually made things worse. Who would have thought that was going to be the outcome of sending people free money. So I'm going to write an article on this. I've written about MMT before, and I'll write an article here in the next week or so with all the data from the study. So it's just kind of an interesting outcome of what did you think was going to happen? So anyway, all right, let's talk about what you need to know before the bell this morning. Google reported earnings yesterday. Actually, earnings beat pretty much across the board. Earnings and revenues beat across the board. One little glitch in the matrix for Google yesterday was slightly lower revenue for YouTube, which was up $1 billion on a year-over-year basis, but less than expected. So the stock's going to be a little bit weak this morning. Tesla also reported earnings, kind of missed expectations on several different points. That stock's going to be down about 7% this morning, but it's had a huge run here lately. So, not really surprising you're seeing a bit of pullback. Again, the whole market's just kind of going through this rotational move right now. Stocks have gotten very far ahead of themselves, and we're kind of going through this correction process. As we talked a little bit about yesterday, the market did correct. We broke the 20-day moving average. We rallied back above it, held it yesterday. So today will be important that the market, if we do break below it. Now this morning, futures are pointing lower, particularly on the NASDAQ because of Google and Tesla. So we'll see what happens. But if this market closes below the 20-day moving average, it'll be important that tomorrow we get back above it. We're kind of flirting with that support right now. Again, nothing overly concerning at the moment, but it is worth paying attention to what's going on with this support level at the 20-day moving average. If we do take that out, the 50-day moving average becomes the next logical target. That's currently sitting right around about 54.30 on the S&P 500 at the moment. So again, not a huge drop lower, but certainly we could be going through a bit more of a correction process. And again, we've been talking about the need for a correction here for a while. So again, this isn't anything. This isn't the end of the bull market. This isn't anything crazy. It's just that we've had a very long bullish trend here. And we're due for a 3 to 5% correction at least, just to work off some of that kind of more overbought extended condition. We're still on a sell signal. That hasn't changed. That's going to put pressure on the market here near term. So again, as we talked about before, continue just to kind of monitor your portfolio risk as needed. Don't take a lot of aggressive bets right now. We reduced exposure to a lot of these big mega cap stocks last week. So, now we're just kind of hanging out with a little bit of extra cash, looking for wherever the next opportunity is going to be. And we'll see how this works out over the next few days. But again, it's very unlikely, right, despite a lot of the headlines, that the end of the AI trade is here and large caps are going to continue just to massively underperform. They're due for a correction, absolutely. But again, take a look at Google's earnings in particular yesterday. Big increases in their earnings overall. Their revenue was higher than expected. Those stocks are where the bulk of earnings growth is coming from. It's not coming from the bottom 490 stocks for the most part. It's mostly from those top 10 stocks that are generating the big bulk of earnings. And we're about to get into a lot of those. The buyback window, which is in blackout right now, right? We have no buybacks going on at the moment. Another reason we kind of have this pressure right now in the markets because the biggest buyers of stocks aren't buying stocks at the moment. That blackout window is going to be opened by about 50% next week. And then by the time we get another week or so out, it'll be back to 100% open. So buybacks are set to start coming back here, after we get through next week for the most part. Buybacks will start coming back into the play. That'll help give some support to the markets here near term. So again, just be careful of narratives, as is always the case. Just manage your risk accordingly. Take some profits, rebalance as you need. But don't take on a lot of really aggressive bets. We're seeing a lot of short covering in meme stocks and small cap stocks in particular. That tends to be a little bit of a risky trade. So be careful what you're chasing and make sure you know what you own. Doesn't mean that all stocks are bad. Just be careful you know what you own and you're not just chasing particularly temporary move in the market caused by a short-term rotation on a technical basis. So that's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff. Almost messed that one up. Danny Ratliff. And we'll talk about investing for the election. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me, as always, on Wednesday. Well, not always. Sometimes he gets in car wrecks. He doesn't show up.
It was not on Wednesday, Lance.
So how's the vehicle?
I don't know. We're waiting and seeing. So, fun stuff.
Yeah. That's always just kind of a pain to go through, right? To have to deal with the insurance. And you just had so much stuff going on lately. You've had this, you've had your house, trying to get that back into your house after getting flooded.
It's been a year.
It's been a year,
yeah.
Well, it's like they say, it always comes in threes, right? So you're just look on the bright side of this is that you're just getting it all behind you at once.
I pray, I hope. I think you're right.
Yeah. You just got to put your head, this is the point about, got to be optimistic, right? Just got to put your head down, realize you're going to get through this. It's going to be better on the other side. Just got to go through the challenges.
Been able to teach a lot of life lessons with the kids this year.
Yeah.
Like, hey, we can control our behavior, our attitude, our effort, how we respond to things. And, I think that's a positive aspect that they can kind of see, all right, this sucks. But we're not going to let this dictate, how we're going to behave, right?
Yeah, but no, and the reason I bring this up is that I think it's also a valuable investing lesson that that we all need to take away from things. We run into these challenges from time to time, right?
Yeah.
And when you're in these challenges, and look, we're going through some stuff with our daughter right now. It's been just really tough lately, but you just have to and investing's the same way. We run into these periods where things look terrible and, there's just nothing's working right and all this type of stuff. And as human beings, we just start to kind of become pessimistic on everything, right? It's like, oh, this is terrible. It's just, it's just the worst thing. And what we have to remember is that these are cycles like everything else in life, right? Life works the same way as the financial markets, is that we just have to look, this is a tough time, whatever it is, it's a recessionary environment, economic data is bad, whatever it is, but we will get through this. It is just a cycle, and we will get to the other side of this, and things will improve markedly. And so it's important to not make decisions that permanently impair our outcomes by, making the wrong decision that locks us into a particular view on something that is going to be cyclical in nature.
Yeah, and I think that, even with that, with markets and what I've gone through this year with, we had, so those of you that don't know, we had a washing machine that flooded our whole downstairs. had a car wreck, truck may be totaled. I mean, small things. And at the end of the day, I consider myself blessed in our family. I go back that, hey, everybody's healthy, everybody's well. That's the main thing, right? And but all these challenges, I think, and going back to the lessons I think I can teach my children have been that, okay, so now these things have happened. Due diligence begins to start again, right? So you're putting a home back together. How do you do so? And God bless my wife, she has a binder, like literally. I mean, it's got to be one of the thickest binders you've seen of quotes, proposals. Trying to figure out, to be a good steward of the funds that we did get from insurance and make sure that we use those funds properly. And we're not just going out because you have money that you can spend, you do so, right? And I think that's with anything from when we talk about, putting a spending plan together in retirement to understanding, how funds work. And our kids have gotten a real close view of a lot of things that probably at their age they don't. And granted, these are small things. But I try to use anything that we go through as just us learning, life lessons. Yep. And so, but you can do that with the market as well. And so, like you mentioned, there's going to be setbacks. There's things that occur. And, there's been so many times we want to attach rationale to the markets and you can't.
Right.
And I think that's going to be a struggle. And, one of the things we're going to talk about today has been, I think that's the lead topic is how do you invest in this environment right now? And what happens based on what happens in November?
Right. Yeah, and that's it. And no matter what your views are, it's like, I don't like this person or I like that person, whatever it is. Whatever it is, the outcome of this is going to be cyclical. And this is the important part is that when things seem difficult in markets or whatever it is, whether it's the bond market, the stock market, whatever, these are all cyclical. These cycles can last a while. I mean, we can be in a period where it's a year or two of negativity and bad outcomes, et cetera. But it will prove cyclical, and then the markets will begin to recover. And there's just 130 years of data that supports that. Markets will rise over time, and so it's important not to make life impairing decisions by just, this happened, so I'm just never going to do whatever it was again, right? I mean, so many people, one of the things about being a small business owner is you have to be optimistic, right? Because there's just when you own your own business, it is constantly a challenge. Every single day, you're going to run into a problem. Something's not going to work right. You're not going to make sales that you thought you were going to make, whatever it is. There's going to be legal issues. There's going to be, health issues, all these things that occur. What happens for most people is they run into a challenge and then they quit, right? There's just, it didn't work, so I'm just going to close up shop, and I'm not going to do it anymore. And so This is why 80% of businesses fail. Most of it is the fact that people are undercapitalized and they quit, right? When they run into the first sign of trouble, they quit. And so it's important when whatever you're doing is to always look past the points of trouble and say, look, things will get better on the other side. I have to navigate this to the best of my ability and realize that things are going to improve. And the markets are that way very much. They're going to give you periods of time where things seem dire, and you're going to see all these headlines about how terrible everything is. The world's going to end. You better be in a bunker. But then the market miraculously gets its footing again. Yeah. And then you have very large returns. And a lot of people miss out on those returns because they're still in the bunker thinking that the world's going to end. And this is the important thing. And as investors, as small business owners, life in general, you're always better off to be optimistic about the future rather than pessimistic. You'll just be happier.
Oh, don't get me wrong. There's been times I've wanted to wrap the family in bubble wrap and not go outside the house, right? Like, okay, guys, we're going to wait this out.
Exactly.
But I know that's not the right thing. And what is that? What type of message does that send? And like I said, these are small things that I'm dealing with, our family's dealing with. But at the end of the day, many people have it much, much worse. So I consider ourselves blessed. But I get the sentiment. I understand why when something goes wrong, you want to typically pull back, go into protection mode. And there are times for that. Don't get me wrong. I mean, there are times that maybe you do need to just sit things out and kind of wait and say, okay, what's next? But the problem is, especially when we go back to markets, is that when people typically get all the way out, they don't get all the way back in. And especially based on political narratives, kind of what's going on, we continue to hear all of, everybody's, ringing bells of, deficits, debt. We know all these things that are going on out there. We know what's happening. We know things are slowing down a bit. But, as you always mentioned, what do we not know?
Right.
And from a risk management perspective, those are things that we try to mitigate. And that's why we do things the way we do. But, from an investment perspective, last week had a handful of phone calls and people were saying, hey, we get down one more day. I think we just need, what do you think? We just go all to cash?
Yeah.
I'm like, no. Hang on. This is natural. This is normal in the course of markets, especially what they've done since the end of June. We should be expecting some of this. So, taking some profits, those types of things, being active, I think that's prudent. But we also don't want to just, rip the Band-Aid off and say, that's it.
Yeah. Well, again, it's just, it's always important. And again, we all go through life challenges. And like I said, just, we just want to keep a positive focus. It's easy to get pessimistic, and pessimistic makes us make bad decisions.
That's right.
So it's always better to be optimistic. So that's your optimistic view for the day. Let's talk a little bit about the election coming up, because, again, this is going to be a lot of talking over the next 3 months. At the moment, or, a couple of days ago, it was almost a shoo-in that Trump was going to win. And the markets were starting to kind of price in what would a Trump victory look like. Now with this replacement with Kamala Harris, the polls have tightened up rather dramatically. And so we may start to see some shift to what if Kamala wins the election, right? What is that going to mean? So we may see some rotation in the markets. But I guess the question is, when you're thinking about the election coming up, how do you kind of invest for that?
Yeah, and I think that's a struggle for everyone because we're looking at something so far out. And I think the struggle is that, a lot of people, and some of the things that I'm hearing right now is that, under Trump, we had a great market. And, outside of 2020, which ended up being a good year, and that significant drop we saw, over 30% due to COVID, we saw that the market did relatively well.
Right.
But the market's also done relatively well under Biden. Mm-hmm. Outside of 2022, we've recouped those losses. Things have been on the up and up. So I think it's, regardless of party, it may be a bigger challenge than many think, in the sense that markets have been extended. Valuations are much higher. We're not in the same spot we were 4 years ago, 8 years ago. And so that could create some different problems on its own. But I think then the bigger narrative is okay, you have Kamala, who we don't know a lot from you can
policy
go and extract, from a policy perspective. We can probably say she's been one of the quieter vice presidents that we've seen. Right. Mm-hmm. And we know some of the policies and things that she says, but, putting it in action is a little bit different than saying certain things. And we know that there's a lot of rhetoric and a lot of things to sway votes that are going on right now on both sides. But then you look at Trump and you kind of see what's happening. Everybody's calling, we have the Trump trade. The market's already expecting or thinking that Trump is going to get in office. And with J.D. Vance, who has been in the tech industry, but also has been relatively maybe a little bit harder on them. You think about what Trump has said, defense for Taiwan, they need to pay for it. So a lot more tariffs. We've seen that with China. We've seen some of this enacted. He's talked about reducing taxes by 1% for corporations from 21 to 20 because he likes round numbers, is what he said. So thought that was kind of interesting. But nonetheless, I think that if we can keep these things, so with Trump, we saw a bigger probably uptick in earnings because of those savings initially, right? Yep. In 2018 that we saw from the Tax Cuts and Jobs Act that was initiated in 2017. So, those are things that I think was passed in 17, Those are things that, we have to be mindful of, but we're not going to get the same type of probably uptick because of those policies as of right now.
Right. We'll talk some more about this on the other side of the break. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never sucker.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
This is the worst coffee on the planet. I'm filing a class action lawsuit against my firm for buying this coffee. It's absolutely terrible.
The Real Investment Show podcast.
I think you bought this coffee too.
I offered you some Death Wish coffee.
I don't want to die this early in the morning.
Same show, your schedule.
There needs to be a nice balance between coffee brands, okay? Can't have complete crap and Death Wish. There's got to be something in the middle.
At realinvestmentadvice.com.
Black Rifle.
There you go. We don't have any here, do we?
No.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Let's talk a little bit about the upcoming election. So two things, and Danny was talking about this, is that, don't get too, look, the markets are going to try to figure out between now and November who's going to get elected, and then try to place bets on the outcome of those policies. So, pretty much if Kamala Harris is the candidate and she wins the election, she's pretty much going to continue what we saw under the Biden administration, right? So, Medicare for all and expanded benefits, green energy, all these type of things, right? So that's going to be that policy cycle. Now, if Trump gets elected and Vance, they're going to be, as Danny was pointing out, working on tariffs, tax cuts. They are pro cryptocurrency, so that's going to be potentially a bid for cryptocurrencies if they get elected. So there's going to be some benefits from that side, regardless of who gets elected. The markets will gravitate higher over time. And this is going to be because that whoever gets elected, the markets will quickly adapt to whatever those policies are, and then money will start to flow into those trades. So again, it's it's important to understand that right now it's a guessing game. Once the election occurs, then the actual bids will go into place where they're going to be allocating capital towards whatever they think is going to be the best for that presidency do. Now, one other thing that's very important to remember is that regardless of who gets elected, it's the House and the Senate that also have to go along with it, because One thing the market does like very much is let's just say that Kamala wins the presidency, but the Republicans win the House and or the Senate. Well, pretty much you get gridlock. Markets like gridlock because they don't have to worry about big major changes, right? We do, maybe there's some small spending things or some executive orders, those type of things, but there's no major impacts to the market. So markets go back to focusing on economics and earnings, right? Which is going to gravitate higher over time just because of the economy's growing and earnings will grow with the economy. So again, it's important not to get too wrapped up in the election outcomes. It's important to understand, kind of what the policy makeup may be. Obviously a Trump administration be pro-energy, pro-oil drilling, et cetera. So maybe you start thinking about, adding to energy exposure in your portfolio if you really think he's got that, the victory kind of in the bag. Oil stocks have been under a little bit of pressure this year. So, there's some opportunity there. If you think, that Kamala Harris is going to win, then, you start thinking about green energy plays in theory. I'm not making any bets right now. I'm just saying in theory, this is kind of where you're thinking. And you start making some bets in that direction. But none of that's going to matter if the House and the Senate don't go along with them, right? Because you can't pass major policy changes. And, this has been kind of a big challenge for the Biden administration. They've had great ideas, but a lot of these big ideas failed to move forward because they didn't have control of the House and the Senate or enough of it. So again, this is just, don't kind of overstretch into, kind of the outcome. It's okay to make a few minor changes here and there, but this is kind of going back to the small cap, mid cap trade that's been going on lately. Yes, those stocks have been outperforming. Fantastic. No problem with that. They needed some catch up, trust me. But a lot of that is short covering. And, to say that this is a massive rotation out of large caps into small and mid caps because of a Trump win, it's really early for that. So just be careful getting too long in a particular trade, getting too much weight in a particular trade that can unwind very quickly if something shifts on the electoral front heading into the election.
Yeah, we got a long time until the election. I mean, I think people are acting like it's already done. But, that what you just mentioned with small caps, I think that's one thing. Do you think that recent rotation into small caps has been maybe that narrative? Trump did really well with the debate. We've seen since then kind of the flow towards small cap.
Right.
But small caps have been beat up. But if you think about that from a policy perspective, if you're going to go after some of the big tech companies, if you're going to go after, really, it's not going after those companies, it's going after their supply chain, right? Where do they get the majority of their products? It's from overseas. Mm-hmm. And so if you're going to ramp up the tariffs, that's likely going to hurt the big guys. So does that derail them?
Well, it does potentially weigh on them some. Yeah. But kind of the big hope is tax cuts will help small and mid cap companies. Right.
Well, not only that, but they don't rely as much on foreign products, right?
But again, as we talked about yesterday on the show, 40% of the Russell 2000 have negative earnings. 20% of them are basically zombie companies that are dependent upon debt because they don't have profits. So they depend on debt to operate and exist. There's a lot of problems with that small and mid cap space that have to be resolved. And again, if you're kind of in the camp of the economy is going to be in a recession in the next couple of years, you really don't want to be in that small cap space because they're very dependent on economic activity for earnings. And so if you take a look at where earnings are coming from, all the earnings growth in the markets right now are coming from large cap companies. There is basically no earnings growth coming from small to mid cap companies. So what are you paying for?
Yep. No, that's true.
Right. So, all right, let's shift gears here a little bit. We got a lot of topics to get into this morning. It's interesting because there's a lot of conversation, and I was talking a little bit about this with John yesterday on the show, but there's as we're moving in towards retirement, we were talking yesterday about making sure we have a good diversification of accounts and those type of things. But one of the issues is that as you start to move in retirement, you're going to have you move from accumulation to spending, right? So you're going to start spending down your retirement accounts, and it's important to kind of get that process put into the proper place, right?
Yeah, I think this is probably one of the bigger challenges that retirees face is that, we've been geared for so long to be an accumulator, and we've done a really good job with that, but then determining exactly what does that spending plan look like? How do you actually go to it? And I've always, equated it back to kids practice before they go play a game. But unfortunately, we're just expected to typically flip a switch and boom, you may get a pink slip from work. You may have a health problem in the family. People retire typically a lot earlier than they were anticipating or at different times. Now, you may be the opposite and things have just worked out great. You're able to call your shots, walk out on your own. That's great. But it's not, even then, I think people struggle in the sense that, now you need to have a plan and you need to start spinning these assets down. So, we go back to the overall bigger, broader, like, what are your goals? And so I think that first things to check off are, the number one thing that nobody wants to do is run out of money. And so the goal of any good plan should be able to assume different types of scenarios, situations. Do we have flat markets for long periods of time? Do we have lower returns? Do we have really negative years in those first years in retirement? As we're beginning to distribute from the accounts, those we know historically can be very challenging times, especially if we're looking at, most people look to try to preserve assets. And, there are a lot of people that are spending down. And so their liquid net worth is declining each and every year. But many people, and Lance, I would think that most people that we visit with, their goal is to preserve what they have now, live off of the interest, Social Security, any pension, any other assets or income producing assets that they have, and hopefully over time see that grow. And that can present big challenges when we're in an environment where, we do see some deterioration in the market. So, the number one thing I think that most people don't want to do is determine what are those goals. And I think this is difficult because they will change. They're going to change over time. And so the biggest thing you can do is what are the main things that you want to accomplish? Are you, what's your bucket list look like? What is your legacy intent? Do you have one? Do you not? What about giving? Do you give to the church? Do you have charities, the animal shelter, whatever it may be? What does that look like each and every year? And then we can start to determine what's the best ways to do so. And so keep in mind, the idea behind a bigger, broader plan is that if we're going to go from that accumulator to a distributor, what's the best way for you to start making those distributions to keep more money in your pocket, but also to ensure that you don't run out of funds or pay too much money to Uncle Sam in the interim?
Right.
And go ahead.
No, I'm just agreeing with you. And because taxes are going up eventually, so.
And I think that's we talk about this often. That's one of the bigger challenges is that there's so many hypotheticals. What does that actually look like? Mm-hmm. Is it means testing? We already have a form of that with Medicare IRMA charges. It's basically a surcharge on your premium if you make too much money. That's one way they do it. And our thoughts, Richard and I have gone back and forth on this as well. Our thoughts have really been that they're going to condense those brackets. There's going to be ways that they're going to come after to get more. I mean, we just saw, and we talked about Kamala and her policy. She wants Medicare for all. Who's going to pay for that, right? Mm-hmm. So that means not just, that's really, kind of expanding the healthcare insurance aspect of things. Right. And so if that's going to be government paid, remember the government doesn't pay for it, you do. So how are you going to pay for that? They're going to raise the amount that they're going to tax you. So not only that, but we could see changes in just the overall tax code. We know that this code expires in 2026. How do we navigate that? Do we front run some taxes now, maybe where you're going to go ahead and load that at the moment? We're going to pay that at this time, knowing that in 2026 this could potentially change. Now, you may be, and we're going back to just a bit ago, we were talking about how do you prepare for this election, and depending on who gets elected, what do you do? This is similar in a lot of ways because now we're having to look at that hypothetical of, what type of policies they do, what do taxes look like? You have one who is more prone probably to raise taxes, one who's more prone to raise tariffs. But these are things that you need to think about. And so, when we look at if you have a giving plan or your, and that may be even within, that may be tied in with your estate plan, where if we're looking to gift funds to somebody, a loved one potentially, do you gift highly appreciated stocks? If you're looking to do it to, maybe a family member or a charity, that could be a way to do it. There's a handful of other ways that we'll talk about when we get back on the other side of the break, but a lot of things to consider here.
And also really kind of what retirement strategy wins.
Yeah, absolutely.
That's kind of the big thing. All right, come back. We'll wrap this up. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So we're just talking a little bit about spending down your nest egg, because this is going to be important as you know, we all approach, you know, that point in time where we have to start spending the money that we've been saving and accumulating. You know, doing it the right way is very advantageous, and you know, this is one of the reasons we talked about with John last week. You know, why do you have an advisor? This is one of the reasons you have a financial advisor. Make sure you do these things the right way. It also comes to a retirement strategy, though, Danny. Just as we were talking about, there's, you know, if you look at different retirement strategies, there's really kind of one that kind of wins over all the other ones.
Well, I think there's a lot of different strategies, and there's not one, so to speak, that wins over all the other ones in a lot of ways, just because everybody's different. Everybody has different kind of perspective on things. Some people may love annuities, some people may hate them. So you could say, you know, a lot of people actually had a conversation yesterday with somebody, said, well, you know, what about if I put X amount in annuities? So, you know, what we can do as well is we can start breaking down. And so really simple, say, okay, you need $100,000 to live on. You get, you know, $55,000 in Social Security benefits. So we need to make up a difference of $45,000 if there's no other additional retirement income. You know, assets are X. How do we break that down? And there are some people that will say, you know what, how can I have some type of guaranteed stream of income outside of Social Security that I want to meet that goal, and then anything else is icing on the cake? And a lot of people do that. You know, I think the problem, you know, we've talked a lot about annuities in the past, and they have a very bad rap because unfortunately many times they're sold, not planned. We think that any time an annuity is done, it needs to be within a financial plan to make sure that it's something that fits, and it cannot be something that you put all of your assets in, right? There's a lot of illiquidity there. There's problems with that. So you would usually use that for a very specific goal. But, you know, we hear about that. That's one way you can go. The other aspect has been that, you know, the old school 4% rules, that's still achievable. You know, we went back, and as of a couple of years ago, obviously with extremely low interest rates, studies were showing that at the time, you're like 2.6 was probably more achievable. And you saw the 10-year at really low interest rates. We were really between a rock and a hard place from recreating income from a fixed income perspective. And, you know, so do you begin to shift more to fixed income now that we see that rates are elevated a bit, albeit, you know, we do believe they're going to be on the decline. So, you know, I think that could be something that where you lock in yields currently. But Lance, you know this. So talking about one size fits all, I mean, we have clients who are in their 90s who will not touch a bond, right?
Yeah.
And I have clients in their 30s who are like, oh, shoot, I know how hard I work to get these funds. I'm saving everything I can here. I just want the fixed income. I'm going to put back into my business. That's going to be my growth, my risk. So they only want fixed income. So everybody's a little different in that aspect. Now, granted, the way we manage money is a little different than most as well, because we don't just typically in a blended model. And what I mean by blended, meaning a model with stocks and bonds, we don't just set it and forget it. It is going to be much more proactive in the sense that we need to take profits, we'll do so. We need to reduce exposure, off of, say, that 60-40 mark, we'll do so. If we need to increase it, we can do that as well. So we have a little bit more liberty in that aspect. But from a perspective on asset management and drawing assets down, I think it's really important to kind of get a much better understanding as far as what you need. And really it does go back to starting with that plan, understanding what is that bucket list? How do we achieve those goals? We've talked a lot about, David Blanchett used to work for Morningstar. He came, where's he at now? He's at one of the big insurance companies now. Right. But he did a lot of studies, and it's something that we actually see in practice quite a bit. They call it the retirement smile. So you start off, you're spending quite a bit more. You're checking those bucket list items off. You're not going to travel probably at the pace you are once you retire, in your mid 60s as you are in your late 70s and 80s. So let's front load that. What other things are you trying to check off the list on? Are you going to purchase a second home? Are you going to pay off any additional debt? I mean, what are those goals? What are the things that you're looking to accomplish? And is that going to be something that happens every year, or is that something that where over time things will, your spending will decline? We also want to factor in if you still have a mortgage. Okay, what year does that expire, right? And at that point, do you essentially get a pay raise, or are you just spending less, and can your plan accommodate for that? But then we start to, determine, okay, so that initially you're spending a lot more. Over time, it begins to decline. Then it begins to creep back up as we see healthcare expenses start to increase. And so we do inflate that at a higher rate just because we know that, healthcare over time, that typically goes up much quicker than our other expenses. And so really having a predetermined plan will help. Now, is anything set in stone? Absolutely not. And I think that's one of the things that, Lance, I think many people struggle with. Doing a plan, or even, that 4-letter word, the budget, people don't like that. And I get it, because we don't want to be told what we can and can't spend. But at the end of the day, we need to know what's achievable. And then how big of a buffer do we need? Most of this planning software assumes for quite a bit of a buffer, because we want a pretty big margin of safety in the aspect that things don't go like we've planned. And so when that occurs, we need to make sure that, that you have that safety net. Now, many people, I talked to quite a few, like, I want to spend my last dollar with one foot in the grave, right? And that's a challenge, because, we don't know our expiration date. If we did, we'd all live differently.
Right, absolutely. But, it does bring up a couple of interesting questions. People are working later. I just saw a comment in our chat talking about, I'm just going to get a job on a cruise ship so I can travel for free in retirement. But there's a problem with that, because if I'm generating income in retirement, then I have the potential impact of paying taxes on my Social Security. So how long can I delay? So am I forced at some point to have to take Social Security, or can I delay it until I'm actually done working?
Yeah, so a couple things with Social Security. So number one, if you're taking it before full retirement age, which is if you were born before 55, that's 66. Between 55 and 59, add 2 months each year. Once you get to 1960, if your date of birth's after that, your full retirement age is 67. If you're working and taking Social Security prior to that, they are going to have basically an earnings test, meaning that if you make too much money, for every $2 over that amount, you're going to have to pay $1 back. So we want to be mindful of that. Now, Social Security taxation, that's a little bit different. So if we're making over $35,000, then you're going to have 50% of it's going to be taxable. $44,000, you're going to have 85% of your Social Security benefits taxable. Now, many people in retirement have that happen anyways. So it's not really a function of, are you getting Social Security and a paycheck? That's okay. But the other caveat here would be is that, how do you start to draw down assets in this environment? Talked about now, we think taxes are going to go up. Should you wait and take required minimum distributions when you have to at now 73? So Secure Act moved that. I still get a lot of questions and calls on what is the required minimum distribution age. So essentially, the age that in a retirement account that you must start taking distributions. Each year, it's going to be based on your 12/31 balance of the prior year, plus a divisor that basically Uncle Sam's going to give us. The IRS tells us you have to take out X amount based on how long they believe you're going to live. So with that, do you begin taking those distributions earlier? So Secure Act moved it from 70.5 to 72. Now it's at 73. So if you're under 73, you are not required to take anything out. But we can make a lot of arguments that we may want to start taking distributions, looking at Roth conversions prior to that age. That way we can get ahead of this. And even if you're not spending them, we may want to max out that tax code, that tax bracket, and essentially spend up to a certain amount or move those funds out, pay the taxes now with the thought that potentially we could see taxes go up down the road. This also, we're kind of jumping around here a bit, but this also goes back to that legacy planning. So new rule under the Secure Act 2.0 is that non-spousal beneficiaries must take distributions and basically liquidate the entirety of a fund within a 10-year period. So they're going to start requiring you to take required minimum distributions if you are a non-spousal beneficiary. So this means if your spouse passes, you can take over those funds as if they are your own. But if both of you pass and it goes to the children or whoever it may be, any non-spouse, then they're going to be required to take these distributions. So now we start going a little bit deeper. Where are your beneficiaries in life? Are they at their peak earnings years? Or so how far do these funds go? Is it more advantageous to do a Roth conversion? And while they still have to take those funds out over a 10-year period, you may be in a lower tax bracket than where taxes will be in the future or where your children or whoever inherits the funds will be. And so we want to see, how do we get the most out of these funds? It may be better to do a Roth conversion if you don't need them or require them to live on. It also could be a great thing just to move it out and put it and use that as part of your spending plan. I mean, we see that often. Yeah. And so there's so many things to consider here that, when we just start going down this list, right? And then, we talked about charitable intent earlier. You can also look at required minimum distributions. You could do a qualified charitable distribution up to $100,000 each year. Now, look, I get it. Most people don't have the luxury of doing that full amount. But it is a way for you to alleviate the tax burden from those funds. And if you're going to go ahead and make those gifts, it would likely be more advantageous to do so out of that retirement account versus out of your checking account. And so essentially you're going to avoid paying taxes on those funds. Another thing we see often is, right now we're seeing a lot of people with a lot of gains, especially in that tech space, some significant gains, done very, very well. Do you go ahead and start paying taxes on that, or are you charitably inclined? Do you want to gift that stock or a portion of it to the charity of your choice? That can be another kind of tool in your toolbox that you should be able to utilize. But, there's so many moving parts with this, Lance. I think that, the biggest thing for people going into retirement is, start to kind of understand, what it is that makes you tick, what it is that you're looking to do. Are there hobbies you're going to pick up? Where will, if we start talking about the quality of life, that typically is going to be where funds will flow to. And you may not be able to do those things now, but you may in the future. And I think that's extremely important to get a very good understanding of you, your spouse, your overall goals. And then we can really start to whittle this down and fine tune this. And I think that's where, people get a lot more comfortable and you get a lot of peace of mind.
Exactly. And I just wanted to know that I can retire at 67, get my Social Security, and go home.
No. Yeah, you're in trouble,
it's right around the corner.
Yeah. No.
All right, wraps up the show for today. Be back tomorrow with Michael Leibowitz. We'll talk about GDP out in the morning as well. We'll talk about what to expect. Also, what's going on with interest rates, Fed policy, all that tomorrow morning, of course, with Michael Leibowitz. As always, we'll see you then. Have a great day.